I want to begin with something most financial analysis gets fundamentally wrong. When people say the petrodollar system is ending, they point to BRICS nations, to China's yuan oil contracts, to Saudi Arabia accepting other currencies. And those things are real, but they are symptoms, not causes. The petrodollar system is not being dismantled from the outside. It is collapsing from the inside. And the reason it is collapsing tells you precisely where capital is moving next, including into a place most American investors have not considered seriously in 60 years. If you have money in a 401k, in stocks, in bonds, or in savings that you intend to draw on in retirement, this transition is the most important structural story of the next decade. Not because it signals collapse, but because it signals a significant durable shift in where value is stored and where it is generated. And the investors who understand the mechanism will be positioned very differently from those who do not. Let me walk you through exactly what is occurring and why. I have spent decades studying how monetary systems shift. And what I have learned is that the most consequential changes rarely announce themselves clearly. They move gradually, then suddenly. The people who recognize them early, who understand the mechanism, not just the headlines, are the ones who preserve and grow wealth across the transition. Everyone else adjusts after the fact, usually at a considerable cost. The petrodollar system is in that gradual phase right now, and I want to explain precisely why, because the common explanation is incomplete in a way that leads investors toward the wrong conclusions. Most commentary describes the petrodollar's decline as an external challenge. BRICS nations trading in local currencies, China negotiating yuan-denominated oil contracts with Gulf states, Russia and India settling energy trades outside the dollar. These are real developments, and they matter. But they are consequences of a deeper structural shift, not the cause of it. The cause is this. The petrodollar system was constructed on a specific agreement. In 1974, following the oil shock and the collapse of the Bretton Woods gold standard 3 years earlier, the United States reached an arrangement with Saudi Arabia. The Saudis would price their oil exclusively in US dollars and recycle the resulting dollar surpluses into US Treasury bonds. In exchange, the United States would provide military protection, security guarantees, and political backing. The other major Gulf producers followed, and what this created was a structural, non-negotiable global demand for US dollars. Every country that needed oil, which meant every industrial economy on Earth, needed to hold dollars, and the most productive place to hold dollars was U.S. government debt. That arrangement funded American deficits for 50 years. It gave the United States what economists call an exorbitant privilege, the ability to borrow affordably in its own currency at scale from the entire world without the inflation consequences that would normally follow. Now, here is what has changed, and this is the part most analysts are not stating directly enough. The United States is now the world's largest oil and gas producer. It surpassed both Saudi Arabia and Russia. It is a net energy exporter. The original premise of the 1974 agreement that the United States needed Saudi Arabia to stabilize the oil market and guarantee supply no longer holds in the same way. The enforcement incentive has shifted. The U.S. no longer has the same strategic imperative to maintain the Hormuz corridor, to garrison the Gulf, to subordinate its foreign policy to Middle Eastern energy security, not because it has become isolationist, but because the arithmetic of its own energy position has changed fundamentally. When the enforcement incentive weakens, the system it was constructed to maintain begins to loosen. Not overnight. These transitions take years, but the direction is established. And what you are witnessing in the Middle East right now, the tolerance for regional instability, the strategic repositioning toward the Western Hemisphere, the calculated distance from the Hormuz calculus is not confusion. It is a system in transition behaving exactly as systems in transition behave. Let me explain what that means for your portfolio. Specifically, the petrodollar recycling mechanism was the primary engine of demand for U.S. Treasury bonds for 50 years. Foreign central banks, sovereign wealth funds, and oil-producing nations held dollars because they required them, and they placed those dollars in treasuries because that was the most efficient place to store dollar reserves. That demand kept Treasury yields lower than they would otherwise have been. Lower yields meant lower borrowing costs for the U.S. government. Lower government borrowing costs meant lower interest rates across the entire economy for mortgages, for corporate debt, for car loans, for everything that the last 50 years of American financial life was constructed upon. When that structural demand for treasuries weakens, which it already is measurably, yields must rise to attract the buyers who remain. And when yields rise on a federal debt load of nearly $40 trillion, the annual cost of servicing that debt increases rapidly. The Congressional Budget Office has already projected that interest payments on the federal debt will surpass the defense budget within this decade. That is not a theoretical concern. That is the arithmetic of the current trajectory. For investors with significant bond holdings, and many people in their 50s and 60s hold substantial fixed income in their retirement accounts, often without fully recognizing it. This is the central risk. Long-duration bonds are particularly exposed. When yields rise, bond prices fall. A bond portfolio that appeared conservative and secure under the low-yield conditions of the past decade looks very different in an environment where yields are rising structurally, not cyclically. I want to be precise about what I mean by structural versus cyclical. A cyclical yield increase is what occurs when the economy overheats and the Federal Reserve raises rates to cool inflation, then cuts them again when the economy decelerates. We have witnessed many of those in my career going back to the Volcker era of the early 1980s. Those are navigable. You hold, you wait, the cycle turns. The structural yield increase is different. It happens when the underlying demand base for the asset is permanently smaller than it was. When the Petrodollar recycling mechanism was the marginal buyer of U.S. Treasuries for decades, and that mechanism is now contracting, you do not get relief simply by waiting for the Federal Reserve to reduce rates. The buyer base has contracted, the yield must adjust to compensate. That adjustment can take years to fully price in, but it moves in one direction. This is the environment we are entering, and it shapes everything else I want to discuss. Now let me turn to the part of this story that I believe is genuinely underappreciated by most investors, including sophisticated ones. The United States is executing a strategic pivot that is the most significant geographic reorientation of American economic and military posture in generations. The direction of that pivot is inward and southward toward the Western Hemisphere, toward closer supply chains, toward resource relationships that do not run through contested maritime corridors 12,000 miles from home. You can see this unfolding in Venezuela. The political and economic pressure on the Maduro government, the opening of energy investment conversations, the recognition that Venezuelan heavy crude is precisely the grade that Gulf Coast refineries were constructed to process. These are not coincidental. Venezuela holds the largest proven oil reserves in the world. Under conditions of normalized trade relations with the United States, that resource base becomes a strategic asset for American energy security in ways that reduce dependence on Middle Eastern supply chains entirely. But Venezuela is only the beginning of this story. There is a place 90 miles from the Florida coast that holds deposits of the exact minerals that will determine which nations lead the next 50 years of technological and military capability, and most American investors have not thought seriously about it since before most of their children were born. Cuba. I recognize that sounds unusual. Let me be precise about the economics. The modern global economy runs on a specific set of critical minerals: cobalt for battery cathodes, nickel for electric vehicle drivetrains and stainless applications, copper for every electrical system in every data center, every EV charging network, every renewable energy installation, rare earth elements for the permanent magnets in wind turbines, electric motors, and advanced weapon systems. These are the physical inputs that the artificial intelligence economy, the electrification economy, and the defense technology economy all require in massive and growing quantities. Cuba is the fifth largest cobalt producer on Earth. It holds some of the largest nickel deposits in the Western Hemisphere. It has significant copper and rare earth resources. And virtually none of those deposits are developed to anything approaching their productive capacity for the straightforward reason that the country has been excluded from international capital markets and modern mining investment for over 60 years. Now consider the strategic context. China currently controls approximately 60% of global rare earth processing capacity. It has systematically secured cobalt supply through investments in the Democratic Republic of Congo. It has pursued nickel in Indonesia and the Philippines. The competition for critical mineral supply chains is the defining resource contest of this decade. Not oil, which the United States now produces abundantly, but the inputs to the technologies that will determine economic and military power for the next half-century. A normalized Cuba with American and allied capital flowing into its underdeveloped mineral sector, with U.S. companies constructing the port infrastructure and processing facilities that decades of embargo have prevented, is not a geopolitical curiosity. It is a strategic asset in a competition that China has been winning for 20 years. The sequence of recent developments is worth examining carefully. The pressure on Venezuela's government, which was Cuba's primary energy supplier, the financial isolation of Iran, which was a significant economic supporter of Havana. These moves systematically eliminate the external support structures that have sustained the current Cuban government's independence from the international financial system. They represent structurally the preparation of conditions for transformation. I'm not making a prediction about the timing or the specific form that transformation will take. What I am saying is that the strategic logic of the Western Hemisphere pivot, the critical mineral competition with China, and Cuba's resource endowment point in a coherent direction, and the historical pattern of how these situations resolve. Venezuela's oil resources attracted capital attention before its political situation clarified, just as investment in Eastern European infrastructure began before the Berlin Wall came down, suggests that patient positioning before the obvious moment has historically been where the significant returns were captured. Let me now bring this back to what it means practically for your financial position. The transition I am describing from a dollar system anchored by petrodollar recycling to one anchored by domestic energy production, Western Hemisphere resource access, and a reconfigured supply chain geography is a transition in where value is created and stored. That transition has specific implications for different categories of assets. Dollar-denominated fixed income, treasury bonds, investment-grade corporate bonds, any fixed-rate instrument with long duration faces structural headwinds as the demand base that kept yields suppressed for 50 years contracts. I'm not saying these instruments go to zero. I am saying their expected returns over the next decade look meaningfully worse than their historical average, and their risk profile is higher than most retirement planning models assume. The dollar itself will face sustained pressure, not a collapse. The dollar remains the dominant global reserve currency and will not be displaced quickly, but a gradual persistent devaluation against hard assets is the most probable path, because the structural support for dollar demand that the petrodollar system provided is weakening. What a dollar purchases in real terms in energy and metals and food and services will continue to decline. Hard assets benefit from exactly this environment. Gold has performed its function across every monetary transition I have studied. When the Bretton Woods system collapsed in 1971 and the dollar was severed from gold convertibility, gold moved from $35 per ounce to over $800 by 1980. Not because the world ended, because the monetary anchor that had suppressed its price for 25 years was removed. The petrodollar system served as a secondary anchor, creating artificial dollar demand that kept hard asset prices lower than they would otherwise have been. As that anchor loosens, the same dynamic applies. Mining equities, particularly those with exposure to the critical minerals I described, cobalt, nickel, copper, rare earths, are at an early stage of what I expect to be a multi-year repricing. The demand trajectory for these materials is not speculative. It is the physical requirement of the electrification and AI infrastructure build-out. The supply response takes years. That gap between demand certainty and supply constraint is where patient investors have historically found significant returns. Infrastructure and construction exposure to the Western Hemisphere, the companies that will construct the ports, the processing facilities, the energy networks of a reshored American supply chain represents a longer duration opportunity. These are not trades. They are positions in a structural reorientation of where American capital is deployed and where American economic relationships are anchored. I want to leave you with one observation that I think frames all of this correctly. Every major monetary transition in history has produced a wealth transfer, not because some people are predatory and others are victims, but because different assets hold their value differently across a transition, and the investors who understand which assets are positioned differently than those who do not. When Bretton Woods concluded in 1971, the investors who understood that the dollar's real purchasing power would decline and that hard assets would reprice accordingly built generational wealth over the following decade. When the petrodollar system was established in 1974, the investors who understood that it would create persistent demand for U.S. financial assets and suppress commodity prices for a generation adjusted accordingly. We are at a comparable inflection point now. The system that shaped the financial landscape for 50 years is in structural transition. The transition will take years, not weeks, but the direction is clear to those who examine the mechanism underneath the headlines. The investors who adjust early, who move out of the assets most exposed to the transition and into the assets most likely to appreciate through it, hard assets, critical mineral exposure, Western Hemisphere resource plays, domestic energy, will look back on this period the way long-term gold holders look back on 1971, not as a crisis they endured, but as an opportunity they recognized. That is the honest assessment of what I observe in this moment. If you found this analysis valuable, subscribe. I will keep working through these cycles carefully and sharing what I observe as clearly as I can. The petrodollar era built enormous prosperity. Understanding how it concludes is the first step to navigating what follows.